Hello, this is Jenny Kassan. I'm here to lay down the law about how to raise money for your business on your own terms and make sure you're super literate about all of the different ways to raise money. So, what I thought I would talk about today is something that would be in an equity term sheet. So if you decide to raise money from investors and you decide to offer an equity investment, there are certain terms that you're going to really want to think about how you want to, what you want to do about those terms. You have a lot of options when you're raising equity. Equity does not have to be cookie cutter. So I love to just talk about the detailed nitty-gritty decisions that you have to make when you're deciding what you want those details to be that your equity investors are going to be, what they're getting, and your term sheet basically just lays out what are your investors' rights, how are they going to get paid. So, sorry, there's something called a liquidation preference. And the liquidation preference is really, really important because it determines what happens if your company either goes out of business or is sold. And when you're raising money, if you are raising money in the venture capital style, then that it's a really big deal what happens with liquidation, because the goal with a venture capital investment is that you will sell your company, and that's going to be how the investors are going to get paid. Now, I love to help people make sure that the investors can get paid in other ways so that there isn't that pressure to be selling your company as the only way investors are ever going to get paid. But even if you have other provisions in your term sheet that talk about how investors can get paid during the life of your company, you still need to figure out what does happen at liquidation, because one, you could go out of business, so you have to determine what your investors' rights are at that point. And two, even if you're not solely focused on a sale of your company, you may someday decide to sell your company. Maybe you'll sell it to your workers, maybe you'll sell it to another entrepreneur, maybe you will sell it to a bigger company if you find one that's a good fit. So you need to figure out, what is it that will happen? What will my investors get if I do sell my company or if I go out of business? So when you have preferred equity investors, they usually get some kind of a preference upon liquidation. And that means that before you can get anything, you and your other co-founders who have common stock or common equity, your preferred equity holders are going to get paid first. So you'll often hear about something called a 1x liquidation preference. And that means that if the company is sold or goes out of business, before you as the founder and the common shareholder can get anything, and of course this is also after all your debts are paid and any fees related to the sale of your company are paid. Anything that's left over after that, the preferred equity holders get first dibs on what comes next. So with a 1x liquidation preference, they basically get back whatever they originally put in. So 1 times what they originally put in. That can change sometimes depending on if there's a change in the conversion price, but basically, to keep it simple, let's just say it's basically what they originally put in. So if you were to go out of business and you were to liquidate your company and sell off all your assets, all the money you got from that would be used to first pay off 1x to the preferred equity holders, of course, after the debt holders are paid, and then anything left over after that you would get. And then if you were to sell the company, same thing. They would first get 1x, and then after that, well, that's where it gets a little complicated. So there's 2 types of preferences. One is participating and the other one is non-participating. So if the preferred shareholders have participating preferred, which they have a liquidation preference with rights to participate, that means that they can convert their preferred shares into common shares, at a certain pre-agreed conversion price, and they can participate right along with you as the common shareholder and get their percentage of the, the money that's left over to pay everyone, whether you go out of business or you sell to another company. With non-participating, so with participating, they're either going to get their preference back or they're going to get to participate right along with you. With non-participating, they will just they will probably convert into common shares. So they can choose to either get their 1x back or they can convert into common, whichever gives them more. So, but you can do this all kinds of different ways. I mean, there's some standard ways that are done on your typical venture capital term sheet, but you can really set this up however you want. So I have some clients where they'll say, first the preferred shareholders get 1x, and then the common shareholders also get 1x at the same valuation, and then everyone participates in accordance with their percentage ownership of the company. So there's many, many different ways to deal with what happens on a liquidation. And liquidation just means basically you either sell the company or the company goes out of business. So you always want to think about that. There is another company that I talk about a lot called Equal Exchange, and they've actually set things up where if they were to go out of business, there's a 1x liquidation preference to the preferred investors, but they can't get anything on top of that. They can only get their original investment back, nothing else. So you really want to think about how you set that up and what, what incentives you're creating by designing that liquidation. They call it the waterfall. Like, how does the money flow if you were to sell the company or go out of business? So that's just one part of an equity term sheet that you should think about when selling equity to potential investors. And don't feel like you have to do it in any kind of, standardized way. Just think about, given how likely it is that you are to sell the company, who you're likely to sell the company to, how would you like that to work? If your investors are getting paid along the way out of profits in the form of dividends or distributions, then maybe that's what Equal Exchange does. They pay them yearly in the form of dividends, and so it's not so important to give them all this extra money in case the company is ever sold, because they're already getting paid as the company operates. So anyway, that's just one part of your term sheet. There's other parts of your term sheet that I will probably talk about on future videos. I try to lay down the law about all the little bits and pieces and tricks and tips that you need to know to raise money for your business on your own terms. Do it in a way that allows you to stay in control and stay true to your mission and values. Also, I talk sometimes about what it means to be an investor, investing in the kinds of businesses that are raising money in these creative ways. Many people are both. You may be both an entrepreneur and an investor. A lot of my clients who are entrepreneurs are also investors. And I love that because I think it's really, really helpful to sit on both sides of the table and feel what it feels like. So if you want to learn more though about designing a term sheet for your business, I am going to be doing a book study where we're going to be going through my book, and my book does include a lot of details on designing your term sheet, whether it's equity or whether it's debt. If you want to just really get into the nitty-gritty on designing exactly how your investors get paid and make sure that it really fits with your goals and your plans for your business. All right, have a great rest of your day. Bye.